Hello, I'm John Pearce, Chief Investment Officer. Welcome to this investment update. Well, the 2026 financial year is off to a pretty good start. We've had the US market hitting all-time highs and all of our options are recording positive returns for the quarter. Today, I'd like to explain why the strength. I'd like to talk about the signs of froth that are emerging in the markets. And finally, despite these signs of froth, I'll explain why we are not inclined to sell just yet. Let's start with some fun facts. So in the September quarter, the US share market, which is the largest in the world, which is the reason why we talk about it a lot, hit a record on no less than 23 occasions. What about September itself? Well, take a look at this chart. September's not supposed to be a great month. If you go back to 1950, on average, September is the worst performing month by quite a long stretch. But last September, it was the best September we've had for 15 years. Strong positive returns. One exception, of course, being the Australian market. October started off a bit jittery. We had Donald Trump talking about the threat of a 100% increase in tariffs on China, and that set markets into a bit of a tailspin. They've since recovered, and October's now showing positive returns. So what is Mr. Market saying? He's basically saying, not that concerned about a trade war. We're not even concerned about the fact that the US government is in lockdown at the moment. And inflation, well, we know it's travelling at around 3%, well above target levels, but frankly, not that concerned about that. However, Mr. Market is absolutely delighted that central banks around the world are cutting rates at a time when the global economy is doing pretty well. How's this for a stat? Central banks have cut rates 168 times in the last 12 months, and the global economy has been growing at around 5.5% in nominal terms. Central banks are allowing economies to run hot. What about the RBA, our central bank? Well, the RBA cut rates in August to 3.6%. Some economists are predicting another rate cut on Melbourne Cup Day this year. I personally don't think that's warranted. In fact, I think there are many justifications to hike rates as there are to cut rates. They're not going to hike, so my advice to the RBA, for what it's worth, is take the next 6 months off. The other big driver of the strength in markets, the tech revolution, or more specifically these days, the AI revolution, and at the centre of it, of course, are those big tech darlings, those money-making machines. Have a look at this graph. In those bars are the profits made by these companies in the last financial year, and the bars themselves represent the expected growth in those profits over the next 12 months. This is extraordinary. A company that makes about $100 billion in profit is expected to grow in line with the economy. Yet look at these expected growth rates. On average, about 30% across these six. That's quite extraordinary. Valuations are getting elevated, but this is cold, hard cash, which is really important. Do we have concerns? Are we in a bubble? Well, I don't think we're in a bubble, but there are certainly signs of froth. And you see froth when speculative assets start getting well bid. Crypto's doing pretty well. We see emerging markets recently outperforming developed markets. We see unprofitable tech companies outperform profitable tech companies recently. These are all signs of froth. What about those tech giants? They're making so much money, surely they're not frothy. Well, as I said, valuations are looking a bit stretched. And those profits that they're making, well, there is quite a change. They used to be very much deployed in buying back their stock or raising their dividends or reinvesting in their core businesses. Today, a lot of these profits are being reinvested in chasing the AI dream. Now, the returns for that are long dated and they're also quite uncertain. So there is a question mark around that. Also, they're engaging what I refer to as a kind of a self-interested money merry-go-round. Now, let me explain what I mean by reference to a massive deal that was just announced between two of the biggest companies at the very core of this AI revolution, NVIDIA and OpenAI. NVIDIA, I'm sure you all know by now, is the darling of the market and makes the best-in-class microchips. OpenAI, well, think about this company as the inventor of ChatGPT. OpenAI has a valuation of about $500 billion US, and it needs NVIDIA chips to continue its development and stay on top. The problem is that OpenAI doesn't make a profit, so it needs an injection of capital. Well, NVIDIA to the rescue. Recently announced a deal whereby NVIDIA invests $100 billion in OpenAI. That company has the money to buy NVIDIA chips. How neat. And of course, these aren't the only two companies involved. There are other companies such as Microsoft and AMD that also invest in OpenAI and are also customer service providers of that company. Then we have the cloud service providers, the Googles, the Amazons. They provide services to OpenAI. So you can see what's happening here. It's a bit of a self-sustaining tech ecosystem that they're all investing in. Now, magically, when these companies do deals with each other, the valuation of both companies rises. Now, there's something that doesn't feel quite right about this scenario. And that picture you've got on your screen, it's not the whole picture. So with these signs of frothiness, is it time to sell? Not yet, as far as we're concerned. Now, what we are doing, we're avoiding the more speculative areas of the market. We limit our exposure to unprofitable tech. We're underweight emerging markets. And of course, as you know, we don't invest in crypto. And what about our big overweight positions in the profitable end of the tech spectrum? We're holding there. And why are we doing that? Well, firstly, there's no certainty that we're actually in a bubble. And in fact, you don't know whether you're in a bubble until a bubble actually bursts. Bear in mind, of course, that these companies are very profitable and that so-called money merry-go-round can be sustained for quite some time. But most importantly, when you're embarking on a strategy whereby you're selling with a view of buying later at a future lower price, it's very difficult to get that timing right. But what happened to that old adage, buy low, sell high? Isn't that a very sensible investment strategy? Let me leave you with two alternative investment strategies. The first one, a buy and hold strategy. You invest $100 100 years ago in the US stock market. Today, that would be worth about $103,000. Let's look at an alternative strategy. You're trying to time the market. $100 invested 100 years ago, and it's switched to cash the next month after the previous month has recorded an all-time high. All right, we're trying to time the market here. Look at the outcome, about $10,000. You're $93,000 worse off. You might be thinking, well, I'm smart enough to be able to time the market so that I'm buying back at the lows of the market. I wouldn't call that smart. I'd call that lucky. So the question is, are you feeling lucky? If not, I suggest timing the market is better than timing the market. Thank you very much for listening.